Thank you for joining us here for another episode of Investments in Focus. Today we are joined by Gavin and Colin from Newlook Capital. They're here to talk about their Newlook Industrial Services Fund and how it might be a good fit for your investment portfolio. If you have any questions following the end of the presentation, please reach out to your Raintree Private Wealth Advisor. With that, I'll let Colin and Gavin take it away.
Super, thank you, Darren. So I'll jump into it here. We basically have two funds here at Newlook. Newlook's a family office that we've kind of grown over the last 7 or 8 years since our inception. There's 4 of us as four founding partners. Myself, Elroy, Abbas, and Tony. I am responsible for the majority of the sales side. And basically what that means is getting our product in front of the average Canadian that wants a good, solid investment that traditionally doesn't get these offered to them from their, say, bank and or other institutions. So I will say this is Industrial Fund 3, meaning we've had 2 before this. And we like to kind of define, industrial services as boring businesses. And what do we mean by boring? We like to say these are predictable, cash flowing, recession resilient, government regulated long-term contracts. So that's kind of our definition of boring. And for you guys that are listening, what is Gavin talking about? What's he mean? So for us in Canada, I own my own mining company in Zimbabwe, not the most regulated country in the world. Canada, super regulated. I make the joke that, I've had 3 kids and had to buy 3 different car seats because they went out of code. So we buy code mandated service businesses. So elevator, gas detection, pipeline inspection, noise abatement, weights and measurements, waste management, fire control sprinkler head. So anything and everything whereby you can put a device on a wall, in the ground, anywhere that has some regulatory authority that makes sure that device is monitored by law. That's it. That's all this fund does. I don't go buy hair salons. I can't do real estate. I buy cash flowing businesses that have some type of control whereby that has to be checked by a technician.
And a nice thing about that regulation is the government contracts that are often associated. So Gavin will probably speak to our wastewater management company down in Alabama, but some of their contracts associated with specific municipalities or little development projects can be upwards of 35, even 40 years. And that leads to very predictable cash flows that we love to see.
Yeah, 100%. That's one of our first business actually was an elevator business. We'd own an elevator service business whereby we'd owned it 4 or 5 years. And we were like, we have something here. It's a super sexy business to be in. Those guys make a fortune. It's regulated by the TSSA. It has to be serviced depending on your province, once a month or every 6 months by law. So we bought it. And then we're like, okay, let's expand on this thesis. Let's keep buying sprinkler head systems. Let's go buy waste management companies, cell phone companies whereby you've got to maintenance the 5G network. So, it's kind of like you buy a white car and then you notice every other white car on the road that you're driving. We bought these service businesses. Now we're like, what about this business? What about that business? So you might think it's a really, really specific focused area. Like, is it big code regulated businesses? Elevator businesses alone are a $75 billion space. Gas detection alone is a $34 billion space. So there's well over 100 billion worth of acquisitions just in 2 segments. So yeah, it's a fairly big space where Newlook, we could keep doing this at perpetuity. And that's another thing that we look at. We like to bring niche offerings via Raintree, one of our founding partners. I think Raintree is our founding partner, whereby they try to find really good investment theses that are long-term. We're going to say recession resilient, not recession proof, because that would be offside, and create a moat around our investors and ourselves to protect the fund. So we like to think of those service contracts, those long contracts, like in the elevator space, was 5 and 7 years. IFSS we have in Florida, and another company one in Alabama has up to 40-year, like Colin said, 35 and 40-year service contracts. So again, really protects us. The recurring revenue protects investors and ourselves. I should say mitigates risk in regards to protecting the NAV of the fund. So really like the thesis. This is our 3rd iteration. a lot of long-term stable investors with us. And for any of those that are new looking at investing, I'll kind of dive into why we like this space if you kind of can't wrap your head around it already. So next slide, Colin. Yeah, so a bit of it is, the regulatory that is occupational health and safety, fire protection and prevention, TSSA, the Water Clean Water Act. There's an unknown measurement of regulatory bodies that exist here in Canada and in the US. So our first fund, we went out to raise approximately 40 million for our first industrial services fund. Exact same theme, just focused on acquiring Canadian businesses, of which ourselves, meaning ourselves, our four partners and our friends and family, put in approximately 14 million of the $44 million that I raised. So we had made those acquisitions. That fund has now been up and running for, I think, 6 years, a little north of 5 years. We've sold some of the assets in there. We still have some of the existing assets in there. And again, since day one inception of our funds, between the dental fund and the industrial services fund, we've never missed a distribution to our investors. So that's important to note. Originally, we had in Fund 1 an 8% preferred return of capital plus upside. And now that we're on Fund 3 and we've evolved and evolved and evolved, our transaction's gotten bigger. We've changed, it's still an 8% targeted return. We've kind of changed as to what the upside and model is moving forward so we could have more of an evergreen fund. But this picture really dictates between the funds kind of our distribution. And as a private equity firm, the value that created by Newlook is somewhat creating a national de-risked industrial services fund. So this shows a kind of geographical as well as some of the sectors that you're in. You'll see up there in BC, you've got Raleigh Fire, Acme Fire, New Tech. In Ontario here with Profire, Denny's Electric, All Protect. IFSS I like a lot. I'm just going to talk to a couple of these companies. Again, all these are code regulated that have recurring revenue, again, regulated by code. So that's the thesis. That's what we're going by. IFSS is a fire control system company whereby they're in municipal buildings for the most part, like schools. So we have our own monitoring software, which is 24/7, 365, that overlays with a lockdown protocol in the state of Florida. So, let's hope it never happens, but a shooter comes into a school, there is a situation whereby doors need to be locked and unlocked. You can't have just one general lock all the doors and nothing opens. So we monitor that, and it's IT monitored again with the state of Florida, whereby that is a software company, but we have long-term existing contracts with those municipalities and with the actual state itself. So I love that business. I actually absolutely love it. We got it at a very good price. We always buy majority interest in all of these businesses that we buy. We never buy minority. And our operators are just super solid guys. Like the dad was retiring. This is kind of a classic situation whereby there's someone's 55 or 60. He's like, I don't want to be in this anymore, or I want to sell it. Or my management wants to do a bit of a management buyout for a certain equity portion, or my son's taking this over, but I need to take some cash off the table. So a really good partnership. And that's how we start all of our kind of negotiations is what does the seller need out of this? What do they want? And then what can we offer to benefit that? So it's a fairly long dating process, I would say, from when we have a full M&A team, Oliver Bloom and Mike Harrison here dedicated to looking and doing due diligence, as you can imagine, on all of these companies to fill our funnel to align with the money that we're raising. So there's not a long J curve. And in doing that, you really get to find out who is your operator. Do you want to partner with these individuals? So some people have foresight in regards to building the business. How can Newlook help? Where some is like, I just want to peel 100% of my cash off the table, at which point we walk away from those acquisitions. So it's like anything, you put 10 deals in the funnel and one good one falls out, but we really have done, and the M&A team have done a great job in regards to finding these. I'm going to talk about Insight in Alabama. This is one of the sexiest companies I've actually ever acquired. It basically goes into a municipality and says, we need a water treatment facility. We need to design, implement, and maintain a wastewater management facility for municipalities. job, as you can imagine, but we also sign a 35 and or 40-year maintenance contract to maintain that facility. So from us and yourselves as investors, that's the huge value add to mitigate risk, and it's a huge part of the recurring revenue. Plus, when we go to sell this to a larger private equity firm, they're going to look at those contracts as paying a possibly higher EBITDA than we bought. I'm not allowed to say they will pay, that's forward looking. So again, really good businesses we try to put in here. The M&A team came up with Advanced Tower that you'll see here and Tower MRL. So these are all 5G high cell phone towers that need to be serviced, maintained, grass cut, bolts fixed, new software installed, of which that network's not getting smaller. So we're trying to do a bit of a roll up in that space. Again, those are super good businesses for us as well. And hopefully that segment continues to grow for us. So it shows a little bit of portfolio, how it's broken up. I'll talk about the first, again, 7 companies in our first fund, the 44 million raised. The recurring revenue is really the thing to take away from what you're looking at on this screen. Recurring revenue, recurring revenue, recurring revenue. So those contracts are vital for the sustainability of the fund and the fund moving forward to be sold. So you'll see what we've done with IFS 2 as well. 7 companies, 44 million in recurring revenue. Super sexy from an investor perspective, as well as myself as a founder. I love that side. And the stronger that we can make those contracts, we often do cross-selling between our companies, because as you can imagine, there's a lot of property managers that we deal with that aren't our clients in subsegments of our companies, but are our clients in other segments. So we often give promotions. If you get rid of, say, one supplier and get us, we'll give you kind of a 10% discount, and then we renew that contract from, say, a 1-year contract to a 5-year contract. So easier for the property manager, and also at the end of the day, signing that 3, 4, 5-year contract instead of 1-year contract is huge goodwill and will help us with a higher multiple in the future. So, and now Fund 3. Oh yeah, I'll talk about this a little bit. Yeah, go ahead, Colin. So here you see kind of like, IFS 2 and 3 are our management track record as to how we've grown these businesses. COVID did the same thing to us, and I just talked about it with the dental fund. But with these contracts, it's not like, and again, I'll speak just about COVID for a minute. It's not as if when we were shut down with COVID, say a range hood inspection and or something could be done by another group. If facilities were done and closed and they're our client, that was just deferred revenue. So again, I'm talking about protecting ourselves, like the moat around our fund was those contracts help protect us. If regulatory changes come out and said, you know what, elevators need a new cage put on top with a new harness, the TSSA regulates this, we don't pay for that. The end user, the client, has to pay for that as part of our service contract. That was above and beyond what we would see the government would do. And then that gets passed on to the property manager. So again, the service side is a very good part of the business for us. During COVID here as well, as you can see, we had a backlog of clients that we had to service. It's not like that client went somewhere else and we lost them to another firm. It's not like, your accountant you're not happy with, you go to a different accountant. This was our client not going anywhere. So you see the 41.9, 41.9, then we jumped to 45.5 in 2021. So our team was really good to kind of maintain what we could, service what we could. Obviously, it was a scary event for everybody in any private equity, in any retail, any home, any investment that you have, public markets, etc. And our team, in regards to, do we let staff go? Do we not let staff go? I'll have to give a lot of kudos to Abbas, our CIO. He's very good at not liking debt. So we have lines of credit available. We do use them sparingly when we need to for an acquisition, but it's nice to have those. But we had a huge line of credit available in our businesses. We were flush with cash at the time. So we kind of halted acquisitions, seen where this kind of storm would take us, and managed, always protect the NAV of the fund. But again, I'll say we have not missed a distribution since the inception of Newlook, some 7-8 years ago, with any of our funds. So good job to all of our team for doing that. So the first fund, like I said, we started out as let's do an 8% preferred return to our investors plus some upside. I think at the time it was 70% upside to investors, and then we went to 60 as we de-risked that fund over time. So the sales that we've made we sold some of the businesses in Fund 1, there's some of them still there. So if you look at the bottom here, we've achieved approximately a 29% gross IRR return on the sale of the assets in that original fund. Again, there's still assets there. So we still have 2 companies we need to sell. So that theme and thesis continued, and we're like, okay, we have something here. Let's build the second fund, which we did a North American play instead of just a pure Canadian roll-up. And again, that fund is fully deployed. It's trucking along. We're giving our 8% distribution since inception to our investors. Again, and those companies we're managing and running on a daily basis. We own majority in all of those, so we control the exit. We always keep the operator on for a period of time. We de-risk it in regards to not giving a large lump sum up front in acquiring those. So protect ourselves, protect the fund, and you as unit holders. But what we imagine moving forward is a lot of these funds, because we have a mutual fund trust and we have an OM that's at 5 years, we have to have a liquidity event. We've seen a huge potential to keep these companies longer. Like if they're good and we know them and they're great partners, why do we want to sell them? We don't. So what we did with our third fund is we kept it as an evergreen fund. So this will be a constant fund that we have, will grow and will grow and will grow and will grow. And the ability to keep some of those large and or super profitable businesses that we see where we could do a tuck in here and a tuck in there and really grow that segment and possibly sell it off later, just grow it and keep it as our annuity businesses, we have the ability to do in this new Fund 3, which is available now to investors. So it's a 95-5 split, which means moving forward, if we see a business that we've grown, it's evolved and it's matured, and we're like, okay, it's kind of a standalone, or wow, we've bought this 9 months ago, it's worth a ridiculous value right now, let's sell it. We have that ability. So again, this fund moving forward will give us a lot of ability to grow, scale, sell assets that we think have matured, give special distributions to investors, of which it's a 95-5 split. All of those profits get split 95% to you as a unit holder, 5% to us as Newlook. So that's the thesis of this fund moving forward. And I think it's well received. We did a lot of asking advisors, asking investors, current investors, big and small, as to what they'd like to see to improve. Again, I'm not going to build something that investors don't want moving forward. So thank you for everybody for their input on that. And again, this is what it looks like, an income focused, plus a little capital appreciation as we build this, a targeted 8% per annum to investors. Again, that's as return of capital. So depending on your situation, super tax efficient, but again, I don't know your financial situation, so talk to your advisor at Raintree. They're super knowledgeable and know exactly where each of these products on their shelf fit. And if it's a fit for you, I'm sure they'll recommend it. If not, they've got some phenomenal products on the shelf for you. So we do take a management fee on this fund. My wife loves me, but we also have to pay some bills. So this fund is a 2% management fee that keeps the lights on. It keeps our analysts in the office, keeps us doing due diligence and making sure, again, to protect the fund and ourselves as a firm moving forward. So again, liquidity, very much similar to our other funds. This one takes CAD and US dollars, minimum investment 10,000, RSP, TFSA, RASP, RIF, all eligible. So I think we've created quite a bit of alignment with this. There is a discount. If you sign up for the DRIP, you get a 2.5% discount on the unit price. So DRIP is always a good way to go if you're not struggling for yield to kind of pay those groceries bills. So keep that in mind and ask your advisor if it's appropriate. Oh, I will say one more thing. Colin, go back for a second. This is important. I just kind of dismissed this. Again, we talk about alignment, but management alignment here, we as ourselves have decided not to take a management fee until January 23, as we launched this fund, what, Colin, 2 months ago?
Yeah, 2.5 months ago was the official relaunch.
Yeah, so what we wanted to do is make sure we have the companies in, get them stable, get the investors their distribution, get the track record going, and then at which point we will take a management fee. But again, our whole goal is alignment, put our own cash in, put kind of, money behind our mouth while we're talking and do that moving forward. So I think that's a big deal, right? Like, we won't take our management fee. Let's de-risk this. Let's get everybody up and running and prove this 95.5 thesis out moving forward. So again, the right thing to do. Sectors of interest. Again, it's huge kind of that we get calls from investors. What about this sector? What about this sector? Crane inspection, pet control, HVAC, non-destructive testing, fire suppression alarm, wastewater management, cell phone tower maintenance. Like, this space is huge. Each kind of thing we look at, we're like, wow, we had no idea it was that big. Wow, we had no idea it was that big. But it's not something a lot of companies are doing. So Newlook kind of prides itself on a really specific focus sector, but that is big. It's massive. It's just nobody's really decided to do a pure roll up in that space. So much like the dental, where we're again acquiring hundreds of dental practices across Canada, it's mitigating risk. It's resilient from our perspective and our long-term investors' perspective, and it's proven that thesis over the last 7 years. So happy with the industrial services fund that we're offering here today. Yeah, I'm not sure if I need to say anything else really.
No, one thing I will jump in with for Gavin is when it comes to the actual deal flow of potential acquisition, potential companies to partner with those owner operators, what we found is our former owner operators have actually enjoyed partnering with us, helping them grow their businesses, and they haven't felt like we've come in and gashed away just to improve the bottom line. Is that we're finding that a lot of these current partners are now referring us to people they know in similar industries or the same industries in other geographical regions, and then providing that introduction so we have a really warm transition into potential new acquisition targets. And I think that speaks volumes, because when we come to the table and look at these potential companies to acquire, a lot of the times we're not the only offer on the table, but we're being taken coming in at lower multiples because of our management and operational experience and reputation amongst our current portfolio of companies. So we see a lot of positive trends in that for our acquisition pipeline.
Yeah, that's actually a really good point. Yeah, you'd rather a warm lead from one of your existing companies that you own, just to show that it's a good relationship and they're helping building the equity in that. So again, we buy always majority interest in these moving forward as well. I talked about this a little bit. Sorry, I'll reiterate it again. So quality, long-term growth, and alignment. So really the quality of Newlook, the assets that we bring to the table. Long-term growth, if you're buying this and want to sell it next month, no, go to the TSX or go to NASDAQ. That's not the right investment for you. Long-term growth is, again, us putting our money behind what we're really trying to do and build this out. So, which is traditional private equity. And then the alignment is, like I said, us always putting our own money into the deal, being aligned with you as investors and unit holders. And again, a little small token is not taking management fees for a year. These are all little things that show kind of your alignment, what we believe in and what we're doing, as well as the head office team and everybody supporting us here. So yeah, I'm pretty proud of what we built here over the last 7 years. Here's a good look at group ourselves. Again, we've added 2 new partners to that. And I put this in, like, and I've said this, I come from small town Ontario, less than 1,000 people in my small town. For whatever reason, my parents are both teachers. And I was always a little jealous of the pension. I've only really ever owned my own businesses, from Australia to Africa to this. And my goal here is to bring institutional grade products like what we have here and a dental fund to the average Canadian, just being able to see it. So I have to give a large shout out to Raintree for doing that, doing a phenomenal job supporting us and really trying to bring these good quality products that the average Canadian just wouldn't see. So again, thanks Raintree, and thanks existing unit holders, and thanks potential unit holders. Right, legal disclaimers. If you're going to redeem risk mitigations, liabilities, here's kind of the redemptions in the bottom left. You'll see the chart. As break fees, as raising money is not free.
I think that's everything. So Darren, we'll turn that back over to you.
Awesome, guys. Thanks so much. To wrap here on another episode of Investments in Focus. Thank you, Gavin and Colin, for joining us today. Your presentation on Newlook Industrial Services Fund. I think you guys did a great job explaining it, but if any investors do have any questions about this presentation or about the fund, just reach out to your Raintree Private Wealth Advisor.
Super. Thanks, everybody.
Thanks.